In 17th century Holland, tulips became as valuable as luxury homes, fueled by speculation. Fast forward to Bitcoin. Its meteoric rise ignited debates over stability versus hype. Do these patterns sound familiar? What connects these events? Patterns of hope, greed, and denial, tied together by the dangerous belief that this time is different. Yet, history proves otherwise. Are we really breaking the cycle or repeating it? Bubbles reflect human emotions. They grow with excitement, spiral with greed, and burst when restraint fades. Then comes chaos. How can you identify the signs earlier and prepare for what's ahead? Let's break it down. Take the dot-com bubble. Startups with no revenue attracted billions based on revolutionary promises. When the bubble burst, trillions vanished. The same emotions fueled the 2008 housing crash. Optimism turned into denial. Why do we fall into this trap repeatedly? Emotional cycles, fear of missing out, unchecked euphoria, and denial overpower logic. The truth is, every bubble begins with genuine excitement before spiraling into overconfidence. How can you benefit from these lessons? By watching for sudden shifts in sentiment. Remember, history isn't just a cautionary tale, it's a guide for navigating market volatility with greater confidence and awareness. Market bubbles thrive on shared emotions. Optimism drives prices higher, greed pushes them to unsustainable levels, and fear causes collapses. Look at Tulip Mania, where prices soared, then crashed, leaving fortunes lost. The story behind Bitcoin features similar waves of excitement and downfall. Housing bubbles follow the same narrative. So how can you protect yourself? First, recognize the psychological traps: herd mentality, overconfidence, and refusing to see risks. Media hype often amplifies bubbles, painting exaggerated pictures of endless growth. Learning to identify these mental and media cues gives you an edge. While history doesn't exactly repeat, it rhymes, and those echoes are your advantage. Economist John Kenneth Galbraith coined the term financial forgetfulness to describe how each generation believes this time is different. Whether it was dot-com stocks or the housing boom, the pattern is consistent. Emotional narratives overwhelm rational thinking. Galbraith suggests staying objective, question euphoric claims, and avoid chasing trends. Media sensationalism often drives the frenzy, only to collapse when doubt sets in. What can you do differently? Stay disciplined, prioritize research, and detach from hype. When others are swept up, objectivity can save you from costly traps. Markets will swing, but applying these principles ensures you navigate them with confidence. Hope inflates, greed expands, and fear triggers collapse. This cycle doesn't just destroy, it reveals opportunities. The key is learning to spot media hype and irrational exuberance early. Stay focused, adapt, and emerge stronger. How can you guard against the next bubble? Start by recognizing its common stages: realistic beginnings, overconfidence, and exaggerated media hype. When prices spike and promises sound too perfect, take a step back. Staying disciplined and prioritizing research gives you a hedge against emotional traps. History offers lessons, not guarantees. Use those lessons to navigate uncertain terrain. Focus on risk management, not full avoidance. Resilient strategies and calm decisions lead to long-term strength. Thanks for joining QuickPulse Global. Don't forget to like, subscribe, and share. Together, Let's decode economic shifts and take steps to smarter, steadier financial decisions.